Imagine you're standing at a crossroads, looking at two different paths for your financial future. One path involves trading your time for money every single day, while the other involves making your money work for you even while you sleep. Most people spend their entire lives on that first path, but today we are going to explore the second one. Property investing is often talked about as a get-rich-quick scheme or a complex game for the elite, but at its core, it is one of the oldest and most reliable ways to build long-term wealth. If you have ever wondered if you could own more than just the roof over your head, or if you felt that a savings account just isn't enough anymore, you are in the right place. By the end of this video, you will understand exactly what property investing is, how it functions, and whether it's a journey you're ready to begin. Why does property investing even matter in today's world? It matters because, unlike a traditional job, a well-chosen property doesn't care if you're sick, on vacation, or retired. It continues to provide value. We are living in a time where inflation can eat away at your savings, and Social Security or pensions often feel uncertain. Property provides something tangible. It's a physical asset that people will always need. In a world of digital currencies and volatile stocks, there is a grounded, quiet confidence in owning a piece of the earth. To put it simply, property investing is the act of purchasing real estate with the specific intention of generating a financial return. This is very different from buying a home to live in. When you buy a primary residence, you are looking for a place that fits your lifestyle, your family size, and your personal taste. When you invest in property, you are looking at a business asset. You aren't buying for yourself. You are buying for a future tenant or a future buyer. You are looking for a mathematical outcome. It is the process of putting your capital into a building or land, managing that asset, and expecting it to grow in value or produce an income over time. You might be asking yourself how people actually turn a house or an apartment into a profit. There are two primary ways this happens: cash flow and capital growth. Think of cash flow as your monthly salary from the property. This is the money left over after you have collected the rent and paid for all the expenses, like the mortgage, insurance, and maintenance. If the rent is $1,500 and your total expenses are $1,200, you have a $300 monthly profit. Capital growth, on the other hand, is the long-term play. It's the increase in the value of the property over several years. If you buy a property for $200,000 today and 10 years from now it's worth $300,000, you've gained $100,000 in equity. Most successful investors look for a balance of both. The reason so many people are drawn to this is because of the power of leverage. This is perhaps the most important concept in property investing. Leverage is simply using a bank's money to increase your potential return. If you have $50,000 and you put it in the stock market, you own $50,000 worth of stocks, but if you take that same $50,000 and use it as a down payment on a $200,000 property, you now control an asset worth 4 times your initial investment. If that property goes up in value by 5%, you aren't just gaining 5% on your $50,000, you are gaining 5% on the full $200,000. This is how ordinary people build extraordinary wealth over time, but it must be handled with care and respect. There are several different ways to enter the property market, and the best one for you depends on your goals and your budget. The most common type is residential investing. This involves buying houses, apartments, or condos and renting them out to individuals or families. It is generally considered the most beginner-friendly because we all understand what makes a good home. People need a place to live, and residential leases tend to be straightforward. It's a stable, high-demand sector that forms the backbone of most investment portfolios. Then there is commercial investing. This involves properties like office buildings, retail shops, or warehouses. Commercial investing often requires more capital and a deeper understanding of business trends, but it can offer higher rental returns and longer lease terms. Instead of a 1-year lease common in residential, a commercial tenant might sign on for 5 or 10 years. While it's often seen as more advanced, it's a powerful way to scale once you have mastered the basics of residential property. Another popular method is what many call flipping. This is when you buy a property that needs work, renovate it quickly, and sell it for a profit. This is less about long-term wealth and more about generating an immediate lump sum of cash. It's high energy and requires a good eye for renovation costs and market timing. While it looks exciting on television, it carries more risk because you are relying on the market staying strong while you do the work. It's more of a short-term business than a long-term investment strategy. For those those who want to invest but don't want the hassle of being a landlord, there are real estate investment trusts, or REITs. This is essentially like buying shares in a company that owns and manages large portfolios of property. You get the benefits of property growth and dividends without ever having to fix a leaking tap or deal with a tenant. It's a great way to diversify your portfolio with a smaller amount of money, though you do give up the direct control and the significant leverage advantages of owning the physical property yourself. If you are just starting out, it is vital to have realistic expectations. You will not become a millionaire overnight. Property is a slow-moving asset. It takes time for the market to move, time for equity to build, and time to understand the nuances of management. A realistic goal for a beginner is to acquire one solid property that pays for itself and perhaps provides a small amount of extra cash each month. Over time, as the mortgage is paid down and the value increases, that single property becomes a powerful financial engine. It's a marathon, not a sprint. You are building a foundation for your future self 10 or 20 years down the line. One of the most common mistakes new investors make is letting their emotions drive the purchase. They buy a property because they like the kitchen or the view, rather than looking at the data. Remember, you aren't living there. You need to look at vacancy rates, local employment growth, and the condition of the local economy. Another mistake is underestimating the costs. Investing isn't just about the mortgage. You have to account for property taxes, insurance, repairs, and the possibility that the property might sit empty for a month or two between tenants. If you don't leave a buffer in your budget, a small repair can become a major financial stress. You must also be prepared for the responsibility of being a landlord, or be prepared to pay a professional property manager to handle it for you. Being a landlord involves legal obligations, maintaining a safe environment, and managing relationships. It is a people business as much as it is a money business. If you treat your tenants well and maintain the property, they are more likely to stay longer and take better care of your investment. Successful investing is about building a sustainable system, not just collecting a check. If you're thinking about starting, the first step isn't looking at houses. It's looking at your own finances. Get your credit in order, save a dedicated deposit, and speak to a mortgage broker to see what you can actually afford. Education is your best defense against risk. Read books, watch informative content, and talk to people who have already done what you want to do. Don't rush into a deal just because you're excited. The right property will always be there, but a bad deal can set you back years. Start small, stay disciplined, and focus on the long-term numbers. To recap what we've covered today, property investing is about using real estate as a tool to build wealth through rental income and value appreciation. It allows you to use leverage to grow your capital faster than many other investments. Whether you choose residential homes, commercial spaces, or even REITs, the key is to stay objective and manage your risks. Avoid emotional decisions, plan for hidden costs, and view every property as a business. It's a journey that requires patience and a willingness to learn, but the rewards of financial security and freedom are well worth the effort. If you found this breakdown helpful and want to learn more about the specific steps to buying your first investment property, please consider liking this video and subscribing to the channel. We post deep dives into real estate and wealth building every week to help you navigate your journey with confidence. If you have a question about something we covered today, leave a comment below. I'd love to hear what part of property investing interests you the most, or what you'd like me to cover in the next video.